Okay, everyone, let's start with chapter number 3. We are entering into risk circuit, control circuit. That is how we did it. Okay. Now, in this, we did this risk chart basically, in which risk chart plus the other areas which were there, which basically looks like this in our chart book or in the charts. Okay. So, this is what we completed. One second. Yeah. So, how does this flow? Let's start with this one by one. Completely focus on the screen. Understand with me. Okay. See. The auditor has to understand three things: the entity and its environment, automate environment, and you will understand the entity on a continuous basis. What is entity and its environment? Our favorite answer, it is REOFINS. So REOFINS, what is the flow? Start A is AFRF, RNI, regulatory and industry factors. Then you have inside that the examples are trend, technological development, regulation, energy supply and cost, competitive environment. In that we are checking product price, demand, capacity, cyclical or seasonal activities, and customer supplier relationship. We are mainly checking the contract. O is objectives and strategies. In that we check business expansion, industry development, new products. With expansion, there is a risk of not estimating the demand properly. Industry development, there is a risk of lack of personnel and expertise. And new products, there is a risk of product liability. F5 is financial performance. In that we had KBC finance, key performance indicators, budgets and forecast, credit rating agency reports, and financial performance analysis. So that we had done N, that is nature of the entity, two areas. First is what are the activities or types, and the second is examples. Activities or types had suit in structure and the way it is financed, operations, ownership, types of investments, and the examples had finances, business operations, financial reporting, investments. And last is S, that is selection application of accounting policies. This is what we did. This is basically your understanding of the entity and its environment. Next, how do you understand the automated environment? We had done something called as 3 plus 3 plus 3. Information system purpose, version, location, architecture, interface, in-house versus packaged, outsourced, key person, CIO, CISO. Next, we did how do you understand the entity on a continuous basis? We had done our own rat and bull story. Okay, so for rat and bull story, we had the um, a girl in the class was walking by the road and she sees that there is a rat following her. That is risk of material misstatement. The rat size is not small, it is big, so materiality. She climbs up the electric pole, so accounting policies. Then her brother is having a nice special romantic walk with his wife. So that is your related party transaction or special audit consideration. Example is related party transaction, fraud, complex transactions. Wife's name is Sai, sufficient, appropriate audit evidence evaluation of that. And finally, wife points out, isn't that your sister? So the brother goes towards the sister, asks her to climb down the electric pole. And the sister thanks the brother, says, thank you, Anna. Anna is analytical procedures, of course. Easy. It's the only Anna we know. Simple to understand this area. So we have your fins 3 plus 3 plus 3. And of course, understanding the entity on its continuous basis. That is your rat and bull story. That completes our the yellow bit. Okay, let's go further. Now we go ahead into the risk part. So risk part gets covered on the right hand side of the chart. Let's do it one by one. First is what is misstatement. Very simple. How you are required to report as per AFRF and what you have actually reported. The difference in that is called misstatement. How you are required to report as per AFRF in relation to act. Right, you will see in your notes also, that is your presentation, amount, classification, disclosure. Again, presentation, amount, classification, disclosure. How it is required to be reported as per AFRF and how you have actually reported packed. The difference in that is called as misstatement. That is basically written at the top here, so you can see it here. That is basically misstatement. Yeah. What are the examples of misstatement? You can see on the screen also. That is capital shown as revenue, revenue shown as capital. FS versus AFRF. Incorrect accounting policies or incorrect accounting estimates. After that, you have window dressing, a secret reserve. Window dressing example can be fake debtors are shown. That is account receivables are shown in a fake manner. Inventory value, if you increase, profit will increase. Window dressing. Similarly, if inventory value is shown less, the profit will also become less. So that is secret reserve. Another example of secret reserve will be showing fake expenses, any kind of fake expenses, fake salary payment you are showing. Even that will get covered under this category. Are you there with me, yes or no? Let's go further, please here. We enter the dangerous area called as the risk chart. So let's go ahead with the risk chart. Let's do one by one in this category. Let's start. Look at the screen. So in this, how do we go about it? Start. Audit risk is equal to risk of material misstatement into detection risk. Risk of material misstatement is nothing but inherent risk into control risk. How do you think about it? Any risk which is not in your control is your inherent risk. Any risk which is in your control is called detection risk. Sorry, is called control risk. Inherent risk into control risk is called your risk of material misstatement. Simple to understand this part here. Okay. If inherent risk is high or control risk is high, or if both are high, then the RMM is high. The RMM is high. If the RMM is high, in your mind, the line should go up. If the line goes up, you have to bring the line down. When you bring the line down, tell me, are you doing more hard work? The answer is yes. Are you checking or detecting more areas? The answer is yes. Is it a good thing or a bad thing? The answer is yes. It's a good thing. In that case, what they're saying is if you bring the line down, it means you're detecting more areas. If you detect more areas, the risk of not detecting something, the risk of not detecting something will be less. It's a good thing. So detection risk is the risk of not detecting something. So ideally, what does the auditor want? If the inherent risk is high or the control risk is high or if both are high, then the RMM is high. If the RMM is high, then the auditor will do the required hard work. So the detection risk will be low. If the detection risk is low, it means you are in a much better position to give your opinion. Your opinion will be more correct. Hence, the risk of giving an inappropriate audit opinion will be less. So the audit risk will also be less. This is what you're doing. Easy. So, inherent risk in simple layman language, how do you understand? When risk can only be asserted but cannot be mitigated, cannot be solved. You can only talk about it. Control risk is when controls fail to mitigate the risk. If you remember, we had done this in the class. If controls is your left hand, risk is your right hand. Regarding sales, if controls are there in place, control risk is low. And regarding, let's say, any item, inventory, if the controls are not there in place, the risk will be high. This is called control risk. This is called control risk. Simple to understand this part here. What is sampling risk? Sampling risk basically means if I take out samples and I have opinion, let's say I am giving a clean report. So I'm showing a thumbs up here which depicts clean report. But suppose if I had applied the same audit procedures on all the invoices, then I may have given a modified opinion. I would have given a modified opinion. So just because I'm checking using samples, I'm giving a clean report. But if I would have checked all the transactions, I would have given a modified opinion. This difference in opinion is called as sampling risk. This is called sampling risk. Okay, sampling risk. What is non-sampling risk? Non-sampling risk is any risk not connected with sampling. Example, management giving us the data in a erroneous manner. In that case, whether you do sampling or whether you take all transactions, your audit will not be proper. Your opinion will not be proper because the data itself is wrong. Second example, audit procedures itself are not proper. So you understand here, even if I check my samples, even if I check all transactions, in the end, my audit procedures are not all right. So my opinion will not be correct. Are you there with me, yes or no? That is how it flows. That is complete your sampling risk and non-sampling risk. Easy. Next, we have done, by the way, just to take you to the main chart, just so that your numbering is perfect. Here we did something called as, once again, here we did something called as question number 1A was misstatement definition, 1B was misstatement example. Inside the risk chart, we are doing question number 2, 3, and 4. This is question number 2, the basic theory. This is question number 3 at the top. This is question number 4. Anyone attending class will understand how the flow is very clearly. Okay. At what levels should RMM be identified? At the FS level, the RMM affecting the FS pervasively, and the assertion level, RMM affecting any TAD. TAD we know very well is transaction account balance disclosures with nothing but means P&L account, balance sheet, notes to accounts. Are we there together? Yes or no? That completes on this part. Next, question number 4. For the purpose of identifying and assessing RMM, the auditor shall do what? So in the class we had done SA 315, line goes. So for the when the line goes up, what is the procedure the auditor does? We had done a hand action if you remember. Identify the risk at the FS level, at the assertion level. Then assess the risk. How do you assess the risk? By tracing transaction or analytical procedures, observation, inquiry, inspection, and early offense. Then you ask yourself, what can go wrong? Multiple misstatement, material misstatements. Okay. So how did we do it? Please here. We identify the risk at the FS level, at the assertion level. We assess the risk. Then we ask ourselves what can go wrong. And then after that, we had likelihood of material misstatement or multiple misstatement. When you assess the risk, you are doing this, you are using your brain. So we'll call it as analytical procedures. Near your eyes, we are doing observation. Near the mouth, we are doing inquiry. And finally, this is your inspection. So you're doing this. And finally, you can also do it by using offense, that is understanding of the entity and its environment. Simple. This completes your R1A, R1B, R2, R3, R4. That is what we complete. Okay. Let's go back to the main chart and do it quickly. Let's start. Now we go here. Let's understand whether risk is a significant risk. Karthik sir, how do we understand whether risk is a significant risk? We are done in two ways. You can use any of the method that you want. First code is from core, and the second is the relative anti-story. Relative anti-story. First, tell me, the you are sleeping after putting that uncle into the washing machine. So now after that, at 4 a.m. someone rings the doorbell. So you come to check who it is. The light is not switched on, so you cannot see a person's face, but you see that there's a lady police officer. So she tells about fraud. So suddenly you put the light on, you see her face, and you are able to see that she is your mother's second cousin. So she is your related party. You tell auntie, why are you standing outside? Please come inside. With outside, we'll remember outside the normal course of business. That when auntie asks you about fraud, you make weird expressions. So she sees that your face measurement has changed. So that is measurement uncertainty. After that, she sees that one 500 rupee note is there and nobody's taking care of it. If you remember in that fraud uncle story, that suitcase had opened and 500 rupee note went there. So you ask auntie, what is this? So auntie tells you, sorry, auntie asks you, what is this? And you are not able to give a proper reply. So she sees there is a complex transaction. And finally, auntie goes to check in the room. You goes quickly to the washing machine and switch on the button. And uncle goes round and round. For uncle, everything is a recent development. I hope you remember the story clearly. Okay, good. That completes your next area. That is which risk is significant risk. You can also use the word from core. I'll take you through the code also. F is fraud. R is related party transaction. O is outside the normal course of business. M is measurement uncertainty. CO is complex transactions, and RE is recent developments. Simple. You can use either of them. Let's go further. Let's go to the next part. Please here. You have to identify significant risk at which is greater for non-routine transaction and greater for significant judgmental matters. We have a small diagram for that. We'll do it from there. So that is basically here. Let's do this. So significant risk is related to non-routine matters and judgmental matters. Let's do it. For non-routine matters, we had a code called M2C2. If you remember, we had a management intervention, manual intervention, complex calculation, and control not being effective. Control not being effective. Simple. That we had done something called as judgmental matters, where the judgment of the management and the auditor may go wrong. The auditor and the management have different opinions in this case about the past. The way we interpret, the way they interpret any law or regulation can be different. That is called interpretation. And second is what you assume about the future. That is called as assumption. Called as assumption. Okay, simple. We had this question. This is also question number 6A and 6B. 6A and 6B. Finally, we had the next area called as documenting the risk. I'll show you the code. We had a code called Dusri Coco. Very easy area. So, sir, what all will you document regarding risk in our own audio documentation? First was discussions with the team members. Next is whatever decisions we took. Decisions. Understanding of the entity and its environment, whatever you understood, you will note it down. Next is source of the information. Where are we getting the information from? Risk assessment procedures that we did. That is basically, again, your analytical procedures, observation, inquiry, inspection. That is your risk assessment procedures. What are the components of internal controls that you checked? Internal control components you remember very well. Let's start. Go for it. Control environment, control activities, risk assessment, information and communication, and monitoring. This is what we have done. Excellent. Then as the 315 line goes up, and finally, what is the situation of controls in the organization. So the risk and the related controls we have done this area. Dusri coco. With this, we complete the risk circuit, which is basically, let me just show you the main chart. Complete the main chart. So this is your risk circuit. We complete documenting the risk also. In terms of questions, I'll just put a tick mark 1A, 1B. Inside the risk chart, you had this as question number 2, question number 3, question number 4. This was question number 5, question number 6A, 6B, and this one is question number 7. So we had R1A to R7. Basically, that is the flow of your risk circuit. Are you there with me, Sano? Comfortable till here? Easy. Can you go ahead now? We go to control circuit now. Let's start. Control circuit is fun. Let's start. Controls meaning. What is internal control? Define. Start. Internal control is a process that is designed, implemented, maintained by the TCWG management employees to obtain a reasonable assurance about FOLA, financial reporting, reliability, operations effectiveness and efficiency, legal compliance, asset safeguarding. That is meaning. What is the purpose of internal controls? Very simple. Again, it is FOLA. Okay, so I'm not repeating it, or we'll repeat it. Financial reporting, reliability, operations, effectiveness and efficiency, legal compliance, asset safeguarding. Comfortable? Next is what are the limitations in controls? Go for it. Nice hand action. Start. Internal control can only provide you reasonable assurance, lack of understanding, human judgment, management judgment. Small boy comes running, small entities, collusion. Okay, you hug the boy. Next is what are the components of internal control? We just did it. We'll do it once again. Tell me control environment, control activities, risk assessment, correct? Information and communication monitoring. Comfortable till here? Okay. Let's go on to the nice chart now. Factors which are relevant to decide whether control is relevant. You cannot check all controls in the organization. So which controls are relevant for which businesses? How will you decide that? Which factors will you keep in mind? So that is this question number 5 in the control circuit. So let's do this very simple area again. Let's do this part. This was basically in relation to this area. Let's start this here. First is we look at the business of the entity. We look at the size of the organization. That is the first two. Then we look at in the next two complexity of systems, complexity of operations. How complex is the organization systems? How complex is their operation? Is it manual or automated? Next, we look at the internal controls and if we look at the specific controls within that, there are specific controls. So 2 plus 2 plus 2. So that is business size, complexity of system, complexity of operations, internal controls, specific controls. Last three, that is risk, materiality, and legal and regulatory requirements. These are the areas that you see that is 2 plus 2 plus 2 plus 3. And based on that, you decide which control is relevant, which control is not relevant for audit purpose. Easy. Then we go into a very beautiful flow. What was this flow? Look at the screen. Question number 5, we see business size, complexity of system, complexity of operations, internal controls, specific controls, risk, materiality, legal and regulatory requirements. We look at this. Based on that, we come to know the relevant controls. Now, relevant controls, what do we check? We understand the relevant controls. Kartik sir, how do we understand the relevant controls? Very simple. Evaluating the design of controls, tracing transaction, observation, inquiry, inspection, and operating effectiveness. Perfect. So we do the evaluating the design of controls, tracing transaction, observation, inquiry, inspection, operating effectiveness. This is what we check. Simple to understand this area. This was your question number 5, my dear students. This is question number 6. What are the benefits of understanding internal controls? Very simple. You will identify potential misstatements, you will identify risk of material misstatement factors, and you will design the nature, timing, extent of further audit procedures. If you have done page diagram 1A with me, you will understand that this from there. Okay. This completes that area here. Easy. So we have done this part. Next, we enter into the next part. Sir, now how will we get the data to check the controls? So we have done question number 6 here, understand. We have done benefits of understanding question number 7. We enter question number 8, evaluation of internal controls by the auditor. Internal controls, for internal controls checking, I need the data to come to me. How will I gather the data? By doing something called as flow check, flow chart. narrative records, checklist, questionnaire. Tell me, which is the most concise way of providing the information? Flowchart. Which is the most commonly used method? Questionnaire. It is questionnaire. Which provides information in graphical format? Flowchart. Which is one of the most boring ways to give information, very exhaustive, too much narrative record. Narrative record. Okay. In which the auditor himself will take the information that he will make his own list of questions and he'll write there yes, no, not applicable. That is called checklist. In which will the auditor give the questions to the client? The client will fill all the questions if required in detail and give it back to the auditor. That is questionnaire. Are you there with me, sir? This is what we have done. Flow and check. Okay, do it well. Huh? This I'm expecting, so do it well. Next, what are the benefits of evaluating internal controls? This is nothing but your Sare Jahan Se Acha song. Okay. Let's do this. This is basically this song. Let's do it. Let's see this. Sorry, let's go for it. Please hear. Benefits of evaluation of internal control to the auditor. Let's see. First is management is discharging its functions. Errors and frauds are to be located. Effective internal auditing. Adequate internal control system. Control is weak. Extent and depth of the examination. Reports, records, and the certificates. Administrative control has a bearing on his work. His work controls adequately, safeguards the assets, appropriate audit technique and audit procedures, worthwhile suggestion, सारे जहां से अच्छा हिंदुस्तान हमारा. It goes in that flow. You will understand this area. Easy. So what have we completed till now? We have completed risk circuit, control circuit, because I told you these two questions, testing internal controls and formulating the audit program. This is the read area. You have to read the area because that concept was already covered while teaching. Okay. So chapter number 3 for us gets over here. So 3 gets wrapped up here. Okay.